Welcome to Learn to Invest. I'm Seth from Everything Money. I'm here with Jimmy, Paul, and Mo. We are talking about what you should be doing and what you can expect if there is a recession, some sort of market crash, how to protect yourself and your investments. Jimmy, I welcome you in.
Hi, I'm Jimmy.
Jimmy, we get this question a lot. Paul, we get this question a lot. I'm pooping my pants right now because the market's down. I'm fearful. Everyone around me. What do I do? You guys tell me.
Right now, I think that see, the tricky part about protecting yourself for a recession or for a down market in general is it's something you really should be doing before it comes.
Go on.
It's something that you really have to, if you add defensive holdings, but adding them when the market's crashing, you're probably overpaying for them. So I'm a big fan of, obviously things like commodities, gold, things like that will do fairly well with higher inflation. That inflation could be a real problem for the economy over the next couple of years. I think doing something like that makes a lot of sense. I think if you can find my bigger thing now, I'm actually going in the opposite direction. Now that a lot of tech stocks are starting to fall, those are the ones I'm looking for because I'm looking beyond the recession. I'm looking beyond the market pullback. If these are going to come back and get into a price range, like a company like Microsoft, if that ever kept falling, I'd kill to get into that stock, but I won't buy it now. I need it to fall below my entry price. So for me, as far as how to protect yourself for a recession, keep a well-rounded portfolio. Try to diversify within different industries, but pay attention to how your portfolio is set up. If you have everything in one industry or everything geared towards even one country or one situation, what if that doesn't go that way? What if inflation goes higher and suddenly your stocks aren't ready for that? If you had one or two stocks prepped in the portfolio already all right, this should do okay in a normal situation, but if inflation goes high, these, gold miners will do fairly well. I think that makes a lot of sense, but you really got to try to look out. You can't react now. You have to react before it comes.
Paul, I want to get your thoughts. Obviously, hosting our Everything Money show, you've really educated me on the concept. If I buy great companies, they can withstand recessions. That always was in my mindset, the downside risks. So what are your thoughts moving forward?
So I always preach this. If you're on this channel and you're learning, you should have 80% of your money in broad-based ETFs like SPY and VOO. Take 10 or 20% of your money and invest in individual stock picks. Now, those individual stock picks should be more defensive. I'm a big fan of GDX and GDXJ. They invest in the miners for gold, and that way you can make a hedge against gold because gold will do better when the stocks fall and inflation goes up, okay? Now, buying good companies, you have to buy good companies, but not just there, at good prices.
Yes, of course.
Right? And in this market, it's a little difficult. Do they still exist? Yeah, they still exist. Absolutely, they do exist. But don't stop dollar cost averaging on SPY and VOO. Your job in investment is this. Your job is, this is the stock market over long periods of time. That's what it's worth. But this is what it does. And you'll never know where it's at peaks. So your job is to invest all along the way. And when you do that, guess how much you've paid? Boom, right? So when it comes to your individual picks that you're learning a process from Jimmy or myself, go use the things we learn and have the emotional tolerance to buy good companies that are not hyped, that will do well in the long run. Buy a good company at a good price, you'll do well. What do you have Microsoft worth? If you could put it in, because Microsoft's a company I love as well, but Microsoft's too expensive. I love Google. In my opinion, Google's too expensive. I love Apple. In my opinion, Apple's too expensive.
Yeah. 227.
So Jimmy has Microsoft worth 227. I think I'm in the 160 to 180 range. Now, I'm probably being more conservative. I don't know why, but maybe he could be right on it. I could be wrong. There's a bunch of different reasons why he puts in a longer growth rate, a slower growth rate in the future, but he also has a lower required return. So these things all play in. But the point is, we both agree that Microsoft's too expensive right now. Would we not agree with that?
Yeah,
and by the way, his 227 price is before his margin of safety, correct?
Yes.
My 160 to 180 is with my margin of safety in there. So we might actually be pretty close to the same number. We might actually be both at a buyer of Microsoft in the 180 to 200 range. Okay?
Yeah, exactly. Yeah.
So I don't know, but the point is, you can never guess when crashes are going to happen. And your job as a long-term saver for retirement is to dollar cost average. Now, your goal also should be that as you become a better and better investor, learn the process better, and become more emotionally tolerant of ups and downs, that you can then shift that 80% of your money less and less into ETFs. Like I did. I used to be 100% ETFs. Then over time, I became more individual stock. Now I'm 100% individual stocks when I invest my money. I don't invest basically in any ETF unless it's a specific play like GDX or GDXJ.
Jimmy, with bad times projected ahead, Mo,
who's projecting bad times? Because last time I heard,
well,
everybody
it's
thinks
very right. It's confusing out there. I would assume for a
people
lot
saw
of
a
our
20%
viewers.
drop in the NASDAQ recently and got scared and said, and I'm glad they got scared, but it went back up in a matter of literally 3 weeks.
So I hear people say with so many articles and YouTube videos about how the end is near, why not just move everything to cash and just let everything settle down?
Because if that was the case, you would have done that 4 years ago when the markets were already overpriced and you'd have missed out on the last 4 years of gains.
Yeah, timing the market is nearly impossible.
Well, I think I did that, Paul. I mean, with
Not 4 years ago.
Well, with my Tesla shares,
yeah.
my Amazon shares.
Oh, absolutely.
At the time, we had a video, Jimmy, and they were overvalued. They were overpriced. I get a lot of gains. Time to get out. And of course, I missed this big run up on both. So I guess you're right. You do never know.
You never know.
Yeah, and guess what? I tell Tesla, why don't I just wait longer? I'm like, the longer you wait for the hype stocks, the less likely you are going to sell when overvaluation happens in the future. And that's the whole key here is the individual stocks you have, a 10 or 20% of your portfolio that should be individual stocks, you have to be reassessing them at all times. Like, okay, do I have a better opportunity somewhere else for another stock? Mm-hmm. Microsoft's gone from $13 a share 12 years ago, 10 years ago or 12 years ago to $313 a share. Okay. Do you have a value play? Like we love Alibaba. I think Alibaba, if I had a portfolio 100% invested in stocks and some of them were Microsoft, Netflix, Apple, I would sell some of those to buy the Babas of the world. That's my opinion. But are you okay buying Baba when the stock price has gone like this over the last 6 months? Mm-hmm. That's the hard part because you can't time it.
Yeah, Jimmy,
Except for Jimmy, because Jimmy bought Baba at $79, that son of a bitch.
Yeah, you're a big fan. I mean, what are people saying in your community about Alibaba? I'm sure there's some fear, some doubt, all of that, right?
I think that there's lots of questions, but it's all along the same thing. As Alibaba was falling, I bought it at 79. I bought more shares at 79. I think my average price is like 126 or something. But I did it because it looks cheaper now. Like as these stocks go on sale, as they get cheaper and cheaper, and the fundamentals are not changing, to me, it's why wouldn't I want to buy more here at a lower price? And
by the way, it doesn't look cheaper. Literally, it is cheaper because the price fell 75%. That makes it cheaper when the fundamentals were still getting better, but the projection of the fundamentals weren't as good. So as people's perception of the future changed. That's all that happened. I made my assessment on Baba all along at 8 or 10% revenue growth. Everybody else was factoring in 20, 30, 40% because that's what they did in the past. All of a sudden, they're like, wait a second, they might not get that. They might get 12 or 15%. Still above my level, so I'm fine with it. I was buying Baba. His base is a lot lower than mine. Mine's like 154. I started buying Baba at 185 and have dollar cost average along the way. Okay, I'm fine with that. Am I at a loss right now? Absolutely. Do I sleep well at night? 100%.
How much of this concept, Jimmy, has gone into your portfolio? Because I would think you have some stocks that differ from Paul, especially in terms of like ones that were high flying and could be affected. What your Google take, if the Activision play, some of these could. Give me your thoughts. I mean,
yeah. So I'm doing my portfolio a little bit different than Paul is as well, because Paul's got this set of money and he's investing it. What I'm doing is I'm gradually adding money to my portfolio, and as I do it, I have to find a new position. Okay, I'm sitting in cash until I find a position that's good, and then when I had the opportunity to buy Alibaba as it was falling, part of that was timing. Okay, I'm dollar cost averaging into a lot of this stuff. So I come in, okay, let me average down on Alibaba. Google, I recently added, but one of the reasons I was adding it is as I was watching my portfolio develop, I realized I was very defensive. Early on, I had Disney, Intel. I was happy with my Intel buy. Then I bought, I think, Lockheed Martin. So I'm adding Lockheed Martin's a very defensive holding, and I was like, all right, maybe I'm being too defensive here. Let me look for some growth, and there wasn't a lot of growth opportunities. So when Facebook dropped, I added some. When Google dropped, I added some. Or I bought some for the first time for both of those. But for me, it was because I was going in the face of the market while tech stocks were tumbling. Now I'm looking at them as, is this a good buy? So for me, that's, it's can we stay ahead of the curve? If we're worried about, the market crashing or something, well, then what could cause that crash? Interest rates. Interest rates look like they're heading higher. Well, there's lots of things we could do to prepare for that. Is investing in banks a good move? Something along those lines. Well, if it is, do that research, because the stocks that are getting hurt, my Alibaba is down. I'm down a little bit on Alibaba, but I'm way up on Lockheed Martin. So it's easy to deal with.
Just like my QQQ, I have a short on QQQ. It's up a ton when Alibaba was down. All right, every single day that Alibaba was going down, QQQ was going down. Therefore, my short was making me money. Okay, so it's much easier that way.
So how do I develop the mindset that I need to be fairly excited that the market is going to fall around me?
It's hard, but surrounding yourself with the right people like we have in our community is definitely the way to go. It's definitely a lonely world out there. We happen to have 3-4 people in this room that believe the same thing. That probably doesn't happen very often in the value investing community. So surrounding yourself with those people, we have the community for you. Everybody can cry on each other's shoulders and then celebrate when you actually learn that this is what you want to happen. This is what's going to give you a great opportunity to buy great companies at great prices. People always say, Mo, what are your top 3 stocks or to buy in the future? And I say, I want companies like Apple, Microsoft, and Google, because they're going to be the most resilient during bad times, and they're going to recover the fastest in bad times because they just print cash. Those are the kind of companies that I want to own.
Yeah, so Paul, I think for normal people watching, I guess I'm kind of currently prepping my cash and getting ready for a big buy.
Yeah, I don't think you should do that. I think you should have 80% of your money, dollar cost average every single month, no matter what's going on in the market, and have your 10 or 20% in individual stocks and keep looking for good opportunities there based on a certain process like we have here. That's it.
Your thoughts, Jim?
Yeah, I agree. For me, I'm not saving any cash or prepping any cash for any potential turn. I'm just continuing doing what we're doing. And if the market pulls back, there's going to be more opportunities there.
When the market pulls back.
Yeah, when the market pulls back, there's going to be opportunities. Stay with the process, stay with what works, and sort of ignore the noise as much as you can. And to me, that makes it so much easier to sleep at night. If you can do that, I think, prepping for the recession, there's no magic answer. There's no magic bullet. Look at your portfolio. Where are you weak? Fill in the gaps.
Check out Jimmy's Patreon below. Check out Everything Money, everythingmoney.com, and we will continue these conversations. That's our take. See you.